What's going on, everyone? My name is Brandon with BiggerPockets.com, author of the book on rental property investing and the co-host of the BiggerPockets Podcast. And today I want to show you my sort of by hand strategy for analyzing a rental property using what I call the 4-square method. Now, it's nothing revolutionary. It's just a way that I picture the analysis of a property so I can decide if a rental property is worth buying or if I just want to ignore it, or maybe I want to find out what price makes a lot of sense. This is kind of the analysis that I do if I'm going to do an analysis by hand. So I'm going to walk you guys through it real quick, and hopefully you get some good ideas out of it. Be sure to add questions to the comment area below this video if you have any questions, and jump into BiggerPockets.com if you want to learn more about analyzing rental properties or buying rental properties, or else BiggerPockets.com is the real estate investing social network, marketplace, and information hub. So we're here for you every step of your journey. All right, with that, let's analyze a deal. I will say this as well. If you enjoy this video, if you think this is a good, helpful video, do me a favor and give me a thumbs up on this YouTube video. It just helps YouTube know that you're enjoying it. So watch it, let me know if you like it, and if you like it, thumbs up. All right, we're good? All right, so I'm gonna talk about the 4-square method for analyzing a rental property, the numbers on a rental property. So to begin with, I've got 4 boxes that I'm gonna talk about. And I'm gonna talk about each one, this one, then this one, then this one, and then this one. We're gonna start talking about income. Now that's usually the easiest for people to understand, and so we're gonna begin there. So I'm gonna go ahead and write this at the top, income. All right. So once we've got this box labeled income, we want to figure out what goes in there. So in this case, the most common rental or income you're going to get is going to be rental income. I think most people know that that makes kind of sense. Rental income. Now there's other types of income as well. For example, there's like if you have a laundry machine, you can have laundry income. You can have, there's storage. You might have a storage shed on the property. You might have something else, other miscellaneous income. But generally speaking, rental income is going to be our primary source of income. And so what we're going to do is we're going to figure out how much that is. Now, today we're going to analyze a hypothetical property, and it is a duplex. So you can see the picture right here. This is the property we're going to analyze together. And this property is on the market, we're going to say, for $200,000. Now, your area might be cheaper, more expensive for a duplex. Don't worry about it. This works no matter if you can buy a house for $3 and a pack of smokes, or if you're going to spend $1 million on a duplex. It doesn't matter. The numbers all work the same way. So we're just going to say $200,000 for this property, just FYI. And it is a duplex. So each unit, we're going to say, rents for $1,000 each. So for those math geniuses out there, $1,000 times 2 equals $2,000. So we're going to go ahead and type in here. You know what? I'm going to use another marker for the numbers. I think that'll make things a little bit clearer maybe. So for the rental income, we've got $2,000 per month. All right, now don't mind my terrible handwriting. I'm doing my best here today on the handwriting. This is actually good for me. So we've got our income, our rental income. We don't have on this property, we're just going to assume we don't have any laundry, we don't have any storage, and we're not going to have any miscellaneous. So I'm going to go ahead and say that our total income for this property, so I'm going to say total monthly income is going to be equal to $2,000 per month. And I'm going to like kind of box this off so we know that this is a special little area right here. Now we're done with section 1. We're done with box number 1. Now we're going to move on to box number 2, and that is the expenses for the property, meaning the monthly expenses. How much does it cost to own the property? And here's where a lot of investors, people trying to buy rental property, mess up, because they're trying to buy property and they think it's going to be a good deal, but they don't understand all the expenses. And so what I'm going to do is we're going to list them all out here. So first of all, let's go ahead and label this expenses. And if you're wondering why this box is smaller than this box, because there's a lot more expenses than income, and so we want to have room for that. So I'm going to go ahead and list down some of the most common ones. Now, if you're brand new to this and you don't know what these all are, you can figure them out, talk to local investors, agents, whatever, or use this list. In fact, I'm going to go ahead and put together this entire document here for you in a downloadable spreadsheet that you can just download today. Try it out, see what you think. Just go to biggerpockets.com/analyze rental property. That's biggerpockets.com/analyze rental property. You can download this entire 4-square, a PDF that you can then fill in on your own to analyze your rental deals. So let's go back to this. But you can fill that in on paper if you want later. But for now, let's go ahead and just list them here. So we've got our taxes. We've also got insurance on a property. Now, insurance. All right, next we've got, now sometimes tax and insurance is incorporated in the mortgage. We'll talk about that in a little bit, the mortgage, but for now let's go taxes, insurance, and then we've got utilities. Utilities. And utilities is made up of a number of things. For example, it can be made up of electric, can be made up of water, sewer, garbage, and maybe gas. Those are the most common utilities for a property. Now, next we've got, after that we've got things like HOA fees, homeowners association fees, if you happen to have any over there. You might have lawn care, lawn or snow. And then you're likely also going to have something known as vacancy. Vacancy. That means every month we want to set aside a little bit of money knowing that at some point it's going to go vacant. And we'll talk about how much to do that there in a second. So we got our vacancy. We've also got our repairs. We've got our what's called capital expenditures, which we abbreviate as CapEx. CapEx is like saving up for big things. Like, every 20 years you need a new roof. So how much should you set aside every month for a new roof or for new water heaters, new appliances, new carpet? It's those big items. We want to set aside a little money every month for that. And then lastly, well, almost lastly, we've got our property management. Let me go ahead and write that here. Property manage. And then we've got, very last is our mortgage, if you don't pay cash. Mortgage. All right, so those are the most common expenses you're going to face. Now, in your area, you might have a few other ones. Again, talk to local investors, see what kind of expenses they are facing, but these are the most common in my area and in most investors' areas. So now we're going to go through and we're just going to write down what the amount is for each one of these. So now each one of these can be figured out one at a time. So if you're not sure what the tax is, go to your tax assessor and find out what taxes are. If you're not sure what insurance would be, talk to an insurance broker. And so each one of these can be figured out one at a time. The more you do this, the more general numbers you'll get to kind of understand. So in this example of our $200,000 property, we're going to assume that taxes are going to run, let's just say $150 a month. Now, maybe you live in an area where taxes are super cheap, or maybe you live in an area where they're expensive. Don't worry too much about it. Again, the numbers work no matter how you do them. So we got $150 a month there. Now, insurance, again, that could differ a little bit, but I'm going to go ahead and just guess about $100 a month on this property. Now, utilities, sometimes the tenant pays them, sometimes the landlord pays them. In this case, I want to say that this duplex, which is a nicer duplex, it's already been separated. So we're going to have the tenant pay their own electricity, their own water, sewer, garbage, and gas. They're going to pay all their own utilities. So for us, as a landlord, we've got a $0 charge there. Now, this property we'll say is not located in an HOA area, so we'll say $0 there. We'll even say that the tenant's going to maintain their own lawn and their own snow removal, so we don't have to worry about that. Vacancy, though, we got to set some money aside for that. Every property I want to set aside money. Now, in my opinion, like in my area, my company, we run about a little bit less than 5% vacancy, usually like 3 or 4, 2, 3, 4. But I like to go ahead and estimate maybe 5%. Now, 5% of what? We're talking of the rental income. So for this case, if I took 5% of $2,000, we're looking at about $100 a month that we're going to set aside just for the fact that someday the property is going to sit vacant. So next we've got repairs. Now repairs and CapEx are kind of linked together because they're both about fixing the property up. Now repairs are more like, hey, the tenant put a hole in the wall or damaged the carpet in a little spot and they got to fix things, right? CapEx is replacing things. So typically what I like to do is maybe, again, it will depend on the quality of the property, how new it is. Is the roof already 20 years old? We're gonna have to replace that sooner. So there's a lot of factors that go into it. But typically, I like to see around maybe $100 a month for repairs, maybe 50 to 100 per unit. And so in this property, I'm gonna go ahead and say repairs are gonna be $100 a month. And this is not an exact science. There's no way to really know. That is a 1 there. There's no way to really know. But we can kind of make an educated guess that about $100 a month between the two properties. And capital expenditures on this property, I'm going to also go ahead and estimate about $100 a month. So total each month, we're setting aside a couple $100 a month for those big items. And a lot of investors don't do that, but I think it is a smart thing to do because those things do happen. I mean, imagine you bought a rental property and then 10 years down the road, you were cash flowing a couple $100 a month, making some good money. A couple years down the road, you had to put a new roof on. There goes 10 years of income. 10 years of profit lost because you had to put a $20,000 roof on. You got to save up for those things. And so I make sure I set aside a little bit of money for that. Next, we've got our property management. Now, you can manage yourself, but in this case, I want to go ahead and assume that I'm going to have a property manager. Typically, my area, property manager is about 10% of the rent, so we'll say $200 a month. And lastly, we have our mortgage. Now, that's not really a thing you can just figure out in your head usually, but there are a million online mortgage calculators. In fact, BiggerPockets has one at BiggerPockets.com/calc, C-A-L-C. But you can go anywhere, find an online free mortgage calculator. They're all over the place. So in this case, when I plugged in, we said earlier that the property was a $200,000 property. Now we got to make some assumptions here. I'm going to put down some money for a down payment, etc. So let's just hypothetically say we're going to get a $160,000 mortgage. So if I do a $160,000 mortgage at maybe 5% interest over a 30-year span, which is fairly typical in today's, interest rate economy, we're looking at about, $860 a month for a mortgage payment. So at this point, we've got a list of most of our expenses, if not all of our expenses. Now we're going to add all these up together. So we've got, $860, $9, $1060, $1160, $1260, $1360, $1460, $1560, $1610. Is that what you guys got? I hope so. Okay, so at the bottom now, we have our total monthly expenses, and I don't really have room for it, so I'm going to put here. Total monthly expenses. Pardon my awkward standing here. Not used to writing on a whiteboard. Total monthly expenses of, what do we say, $1610. I'll put a little box around that because we want to call it important. Whew. All right, so we've now got our income. We've now got our expenses. Now it's time to move on to box number 3. For box number 3, we're looking primarily at cash flow, meaning how much extra money do I have every month? Now this is usually pretty easy to calculate once you've got box 1 and box 2 finished. So box 3 is going to be your cash flow. And to know that, all we want to do is income minus expenses. So our income on this property, we already know. Let's go back to our red marker. Our income was $2,000 per month. Our expenses was $1,610. And so to figure out our actual monthly cash flow, we're just going to take this minus this, and we're left with what's that, $390. And that is our total monthly cash flow. And I'm going to put a little box around that because it's an important number. So we've now got income, expenses, cash flow. But the question is $390 a good amount of cash flow? You can't answer that question. It's kind of like asking, is, peanut butter the best color? I don't know. It doesn't really make sense because we don't know anything about that number. We don't know what's around it. We don't know how much money. Did you put $1 billion in just to make $390? Or did you put $2 down to make $390? So we have to compare it to how much money we put into it. And that is called your cash on cash return on investment. Big word, cash on cash return is how we're going to summarize it. And that is what box 4 is for here. So we're going to write cash on cash ROI, return on investment. Now don't get complicated or don't get confused by the kind of complicated jargon here. All it means is your money earning, what kind of percentage is it earning? If you were to stick $1,000 in the bank and then they paid you $100 this year, that would be a 10% cash on cash return. It's like, what kind of return on your cash flow are you getting? And so we're going to go ahead and figure that out now. Now that's a pretty easy thing to figure out, but we have to first determine how much money we put into a deal. That's the first thing we do when we want to look at return. We want to know how much money we put into it. So to do that, we're going to need to add up all the money we put into this. So we're going to start with our down payment. And what else would we have to pay when we buy a property? We have to maybe do closing costs. So closing costs. What else? Maybe repair money or rehab budget. So we got a down payment, closing costs, we got our repairs, and maybe just miscellaneous. I'll just add miscellaneous other. Who knows, maybe you, in the process, I don't know, maybe you want to, who knows, whatever. Appraisals, whatever, but that's kind of part of closing costs. But either way, when you buy a property, there's a lot of areas you might spend money on to get it. So we're going to add all those up together to get our total investment. All right. So our down payment, in this case, earlier we talked about the property was listed at we bought it for $200,000. So if we bought it for $200,000 and we put we'll say a 20% down payment. 20% of $200,000 is $40,000. So a down payment, let me switch to the red marker, $40,000 for down payment. Now we also had closing costs to buy the property. When we bought it, we had to pay the realtor, or not the realtor, the title company or the attorney. We had to pay for an appraisal. We had to pay for loan documents and loan fees and all that. So we'll say closing costs in this case was $3,000. Now, maybe it's more, maybe less in your area, depending on your loan and your area, but we'll say $3,000. And let's just for simplicity, when we bought the property, maybe we wanted to repaint the outside. Maybe we wanted to make it look a little nicer. So we're gonna say, how about $7,000 for a rehab. So again, I think that's usually painting the property or doing whatever. So in this case, our hypothetical property here, we spent $40,000 on down payment, $30,000 in closing costs, $7,000 on rehab, and I'm gonna leave this one blank. We'll say $0 on miscellaneous other. But adding them all up, our total investment was, at this point, $50,000. So we've invested $50,000. So, and here's where we're gonna figure out our total cash on cash ROI. To figure that out, we wanna take our annual cash flow, which we know our monthly cash flow, so we're just gonna take our monthly cash flow of 390, multiply that by 12, and we're going to get, I did that calculation earlier, $4,680. $4,680. So we've got $4,680 in annual cash flow, and now we're going to divide that. So to figure out your cash on cash return, we're simply going to take our annual cash flow, and we're going to divide it by our total investment. So annual cash flow we already know was $680. Divide that by our total investment, which we already figured out right here, $50,000. And what are we left with? In this case, 4,680 divided by 50,000, trusty calculator, works out to a 9.36%. It actually comes out at 0.0936, but we want to make it a percentage, so we just multiply it by 100 and add the percent sign. So we're left with a 9.36. So our cash on cash ROI is equal to 9.36%. So that is how we analyze a deal using the 4-square method. We got 4 boxes, 1, 2, 3, and 4, to figure out our income, expenses, our cash flow, and our cash on cash ROI. Now the question becomes, I know a lot of people are wondering, is a 9.36% cash on cash return good? Now this is when it gets a little bit tricky, and we could talk for hours on this, but this is really going to depend on your goals, your strategy, what you're trying to do, and what other investments you can have. For example, let's say you could stick your money in the stock market today and know that you can make 20%. Now that's doubtful, but let's just say you could do that, right? Then 9 doesn't sound very good. But let's say you're earning 2% on your stocks over the past 10 years. Well, then maybe this is a fantastic return. In fact, over the last 100 years, the stock market's been like 6-7% average. So this actually does a little better than that. So if I was comparing between this and putting it into the S&P 500, I might choose this over that. Now another thing we did not talk about today, and we can't really do it with this method, and it gets a lot more complicated to do by hand, and that is your overall return, or even more complicated, your internal rate of return. What those numbers do is they go a lot deeper into, well, are you building equity? For example, let's just say that this property we bought, everything worked out fine, we got the numbers, we came up with a 9.36% cash on cash return. What if that property wasn't worth $200,000? What if we got an amazing deal and in reality, all the other duplexes in the area were selling for $1 million? I mean, let's just be crazy, $1 million. So we could turn around tomorrow and sell this property for $1 million. Well, now this deal looks a whole lot better, right? Because although our cash on cash return, meaning the return on investment from our cash flow, although that is 9.36%, we've got a ton of equity that we could sell the property and make a ton. It's almost like we're flipping it, right? And so cash on cash is just one aspect to look at. If you have a property with a ton of equity, that can be another thing. And for that, I like to look at your total return. So let's say after 5 years, if the property went up in value 3% per year and we sold it and we paid realtor fees, how much would we get? How does that turn out to an overall return? That is a number that I care a lot about, and that's something that we're not going to be able to do by hand very easily. You might spend a half hour, 45 minutes to an hour figuring all that out. And so what I recommend instead is if you guys are interested in learning more about analyzing deals, jump into BiggerPockets.com/analysis. BiggerPockets.com/analysis. What that site is it's the home of the BiggerPockets rental property calculator, house flipping calculator, a BRRRR calculator, which is kind of a cool thing you can go look up, and then the wholesaling calculator. And what these calculators do is they let you to basically do this process, but they do it in a much more organized manner. It's just 4 simple pages, almost like you have a page for your details, you got a page for income and expenses. You're basically entering all this number in, but then it's also going to ask you a few questions like, what do you think the future is going to look like? What kind of returns do you want to look in the future? Or what kind of appreciation do we expect in the future? What do we think the property is worth today? And then at the final result of that, you can see like this PDF document that shows you what's going to look like next year, the year after, the year after. You can get some really good estimates for the future, including total return. So I'd highly recommend digging into those calculators. You can get to them at BiggerPockets.com/analysis. So the last thing I'll say about analyzing properties, every single week now on BiggerPockets, I host a live webinar, a live class, kind of like this, except I'm using it on a computer and sitting down and being lazy. And I teach different aspects of real estate. Sometimes I'm talking about buying duplexes. Sometimes I'm talking about flipping houses. Sometimes I'm talking about analyzing deals, finding deals, all that kind of stuff. And so I do those every single week. They're completely free to attend live. And so I want to encourage you guys to show up, sign up, BiggerPockets.com/webinar. And the reason I invite you for that is because every single week we analyze a deal together. Because I think this analysis process is so important. So every week we dig into a property, a real life property, a very specific one. We find it on the MLS together or on the market. We find it and we look at it, we analyze it, we figure out where it's worth buying, where it's not worth buying. And we have a lot of fun doing that. So again, you can sign up for that, BiggerPockets.com/webinar. And I hope to see you at one of our BiggerPockets webinars. So I think that's about it for now. If you guys have any questions, like I said, jump into the comment section of this page, ask your questions. And if you know the answer, please jump in and answer questions as well. I can't get to all of them. So be sure to kind of interact with people. And like I said, check out BiggerPockets.com/analysis to dig into the property analysis tools on BiggerPockets.com. So hopefully you guys have a good indication or understanding now of how to analyze for cash flow and cash on cash return, how to do the numbers on a rental property. I will see you around the BiggerPockets community. I'll see you on the BiggerPockets podcast or on BiggerPockets webinars or maybe just hanging out in the forums. For BiggerPockets.com, my name is Brandon, signing off.